This is the current federal tax developments for the week of June the 12th, 2017, brought to you by the Loscalzo Institute and your state society of CPAs. This week, we've got a number of things that happened. We had the IRS issue automatic relief for some late elections for portability that we're going to discuss, and a revenue procedure issued very late in the week. The big news that occurred this week, a lot of you probably have already taken a look at, is the IRS got into the question of whether or not they could charge for issuing PTINs, and the answer from the district court in the District of Columbia was they couldn't. We have a case from the Ninth Circuit of a single-member LLC partner causing a partnership to fail to qualify for the small partner exception from the TEFRA audit rules. And we have a preparer who discovered the limits of privilege when neither the federally authorized tax preparer privilege nor her Fifth Amendment privilege allowed her to escape answering questions from the IRS about some issues regarding one of her clients. Well, it's this week, we're in summer, and I've got some courses coming up here. In Bozeman, Montana, at the end of July, I'll have a couple of courses going. Realize it's a little over a month from now, but you could be planning and get ready, and Bozeman should be a very wonderful place to be that time of the year, certainly much nicer than Phoenix. So I look forward to getting there. On July the 27th, I'll be doing a course on the income taxation of trusts and estates. That session will include a discussion of the Montana Principal and Income Act, because that's important for those of you preparing 1041s in order to compute the thing the IRS refers to as accounting income, which, as we'll discuss, has an impact on DNI. So we'll talk about how all that works in and the whole issue with the income taxation of trusts and estates in that situation. The next day on the 28th, I'll be doing a session with depreciation, repairs, and fixed assets. That course will discuss all of the neat issues of what these days can we expense off immediately, what things are eligible for Section 179 under the current rules, what things qualify for bonus depreciation, what things can we just charge off as a repair, and the radical changes that took place with what we have to capitalize in terms of real property, especially buildings, and the issues involved with that since we had the new 2014 final regulations on capitalization. All of those issues, we all have to deal with it. So it's one of those things that makes sense now that all the dust is settled to take a look and review, following the PATH Act and following the 2014 regulations, where do we stand with handling depreciation, repairs, and fixed assets? That'll be in Montana. If you want to sign up for that course, go to the Montana Society of CPAs websites and you can sign up there. On August the 1st, I'll be heading to New Mexico. I'll be in Albuquerque at the New Mexico Society's offices. On August the 1st, I will be presenting a course with Accounting Methods as a Tax Planning Service. That course is going to talk to you about all the interesting problems we ran into with the Form 3115. You've had to deal with one of those. You know they are not necessarily the most fun form to work through. They also are interesting to determine in what cases you need to or may have to file one, and what cases you might want to file one. Sometimes we can change an accounting method to benefit the client. We'll also have to figure out what in the world is an accounting method, because that's obviously your starting point. So all of that will be discussed on August the 1st. On August the 2nd, I'll be doing a financial planning course, Financial Planning Strategies for Life Wealth Cycles. So we'll talk about some of the general planning courses long-term that you can do to look over a client as they go through different stages of life. So we'll look at all the planning type options that are available for that. That'll be on August the 2nd in Albuquerque. Again, if you want to sign up for those courses, check the New Mexico Society of CPAs websites. Both of those courses will be at the Society's offices in Albuquerque. Let's go ahead and take a look at the start of the week. And the first thing we have coming up this week is Revenue Procedure 2017-34. This procedure that was issued on Friday, June the 9th, adds some potential automatic portability election relief. If you want to do this, if you need to make the election and you discover you failed to timely make it, it covers certain, if you do it within a certain time frame, and certain estates. Portability was added to the law back in 2010. Portability says that when one spouse dies, the executor of the estate, which quite often is the surviving spouse, can make an election to take any part of the lifetime exclusion, which in 2017 amounts to $5,490,000, that was not required to be used by the decedent's estate, and drop that onto the surviving spouse's 706 that would be filed later, giving them the deceased spouse unused exclusion amount, DSUE. Now, there's some complications there because the surviving spouse remarries. Potentially, we can lose that DSUE. Also, it's one of those things to manage. It also, is not going to work the same as a credit shelter trust because any growth in the assets, if the assets grow to more than $5,490,000 that transfer to the surviving spouse, we're not going to have any protection for that. But quite often in a simple estate plan, what the spouses want to do is when one dies, they want everything left to the other spouse. And that's really what portability was set up for, because if that was true, none of the exclusion was used because all of the transfers to surviving spouse were exempt from the estate tax. So we can just plop the $5,490,000 on the surviving spouse. And by the time that spouse dies, we're probably going to be able to exclude over $11 million from estate tax. So the surviving spouse can have direct ownership of a much larger share of the assets with no trust being required. And we get at the second death a step-up in basis, which at $11 million, you have to remember that in many cases for most clients, the real death tax at this point is not the estate tax, it's the income tax on selling assets afterwards if we don't get the basis step up. So a credit shelter trust in that scenario dies an estate tax that would never have been due, but create an income tax that would not have been due except for the fact that we bypass the second estate. So portability is one of those things, we like to use. The problem is, of course, though, you have to elect it. And if no estate tax return is required, you have to elect it still by the date you would have filed an estate tax return. Now, that's kind of interesting because Congress actually said you had to do it by the date your estate tax return is due. However, as more than a few commentators pointed out, and the IRS realized, if the estate isn't above $5,490,000, there is no 706 due. So the IRS interpreted that to mean that they had to set a due date. The due date they set was tied to the 706. That would have been required if you'd had a large enough estate. The IRS, after these rules came out, of course, a lot of people, not a lot, but there's been a number who have missed this, and it hasn't been discovered till after 9 months is run. The 706 option is no longer available, and they discovered, we should have elected portability, because when we add what came from the deceased spouse to what's held by the surviving spouse, we suddenly are sitting with an estate that's going to be above more than $5,490,000 if the surviving spouse dies, here in the near future. And at some point, the surviving spouse dies, and basically, it's not likely our exemption will have grown enough to cover that person. So I need to make this, I should have made this election, it wasn't done. So the IRS received a lot of private letter ruling requests. The private letter ruling request requested under Regulation 301-9100-3 that we be granted the right to make a late election. The IRS decided that if you weren't required to file a 706, they had the authority to do this because the IRS has always taken the position that if the date was set by the IRS in regulation, the agency has the right to grant relief. But if the date is set by statute, which, by the way, it is if a 706 is required, because Congress told us the date there, then they can't grant relief. So the service said if no 706 was required, then we have no problem with this. We'll go ahead and we'll grant relief. And they've been granting quite a few of these. In fact, the problem the service has now found is they're getting way too many of these. So the IRS said, okay, we're going to stop this. In Revenue Procedure 2017-34, we are going to provide for automatic relief in certain circumstances. The first circumstance is you have to apply for it within a certain time frame. Now, relief is available to any estate that qualifies if it applies by the later of January 2nd, 2018, or 2 years after the date of death of the decedent. The January 2nd, 2018 date is a temporary date to allow us to cover those estates where somebody died in 2011. There was no election made for portability, and now we'd like to make it. Because we didn't have automatic relief prior to this particular ruling, except in very limited cases, we're going to, at this point, have the right through January 2nd of next year to just make elections on all estates that have been eligible for portability, whether or not they actually made the election, if they were not required to file a 706, or they didn't file a 706. There's going to be those two requirements. Otherwise, going forward, it's going to be 2 years from the date of death. So if somebody dies today, you're going to have 2 years to make the portability election if no 706 is required. Now, some of the requirements for an estate to be able to do this are found in the revenue procedure. And the revenue procedure says in section 3 that following things have to be true. Number one, the decedent has to be survived by a spouse. Well, that kind of makes sense. They have to have died after December 31st, 2010, because portability didn't exist before that date. And they must have been a citizen or resident of the United States on the date of death. We also have to find that the executor was not required to file an estate tax return under 6018A. As we'll discover later, if the IRS later determines an estate tax return should have been filed on the first death, any relief you get here is null and void. Third, the executor did not actually file an estate tax return. Presumably, if you did file a estate tax return when you weren't required to file one, you should have figured out, to make the election or not. We're going to assume you meant, so we're not giving you a second shot at this. And the executor has to meet all the requirements to do relief. There's certain steps you're going to take. Remember, it's not available if an estate tax return was timely filed. You can't do this. And remember that this is merely a safe harbor, automatic election. So if you don't qualify for this automatic relief, you can still go for a private letter ruling if you otherwise can meet the criteria. That is, you weren't required to file a 706, and you convince the service that it's okay for you to get this relief. You still can go the standard, pay the fee, and get a private letter ruling. Now, what you have to do is the qualifications for relief. A person permitted to make the election on behalf of the decedent has to file a complete and properly prepared Form 706 on or before the date for, the due date of this, which would be January 2nd, 2018, or the second anniversary of the decedent's date of death, whichever is later. Now, because this is being prepared solely for portability, you do get to follow the, kind of more liberal rules found in Regulation 20.2010-2A7. Right? We can estimate certain things. We don't have to be quite as detailed on this 706 as we would if it was required. Secondly, the executor that files that 706 must state at the top of the form the return is filed pursuant to Revenue Procedure 2017-34 to elect portability under Section 2010C5A. As I said, if we later determine that the estate should have filed a 706, and it didn't file a 706, that is, it had an estate of more than $5,490,000, or estate plus gifts got you over that, then any relief here is null and void. The other thing they point out is this doesn't open the statute for gift tax. So if somehow, which is not going to happen very often, but somehow let's say the decedent died in 2011, we transferred the assets, to the surviving spouse. And let's say in 2014, we made a taxable gift, or the surviving spouse died and we paid estate tax. So we paid either gift tax or estate tax in 2014. That would not have been due. Well, the way this works at this point is you have to file that claim for refund by the extended due date, basically by 3 years from the date the return was filed. So let's assume that we actually had the due date. We made the gift in let's make the gift in 13. He died in 11. We made the gift in 13. So that would have put it in 2014 when the gift tax return was due on April 15th. Let's assume we filed it on April 15th. That means that we have to, by April 15th of 2017, have filed our claim for refund. While we can still elect portability under this rule, because we're going to do it before January 2nd, it's not going to allow us to go back and get that gift tax because that claim had to be filed by April of 2017. Now, that's not going to affect a whole lot of people, probably more often estate tax rather than gift tax, because most often the surviving spouse is not going to receive $5.5 million and then gift it all away, to get them over the limitation. But I could definitely see estate tax being triggered if the surviving spouse had died in the interim. It does not open that statute. This revenue procedure, though, does provide that if the statute is open today, let's say that statute is going to close because you filed your gift tax return back in, let's say in August of 2014. So we have till August of 2017 to make the claim for refund, but we're not going to be able to get the 706 together by then. We can file a protective claim today that they will be held until such time as we get the 706, which we have until January 2nd of 2018. So we have that limited structure. Once we get to the 2-year time frame, most often the statute on any gift or estate will still be open at the time that we're going to be filing this, this automatic late relief 706. So we're probably going to be able to recover any tax if we somehow had paid the tax. Most likely within 2 years, we're going to figure out when somebody says, oops, we owe tax, figure out, wait, we want to get this relief. So I suspect there won't be many refund claims issued, except for maybe some of those who are, had a death and for whatever reason hadn't fixed things. So there's a lot of discussion, in fact, 3 different examples of how this works in the regs, but it probably won't affect very many people who have actually paid estate tax or gift tax and now suddenly want to make a late portability election. Will affect some, I'm sure. The ruling also states that if you qualify for this, this is the only way to get relief. So be aware of that. Next up on our discussion, let's go ahead and take a look at what was the big case of the week for a lot of people. This was a case of Steele versus United States, or United States District Court for the District of Columbia. The citation is 119 AFTR 2nd, paragraph 2017-818. This came down on June the 2nd. The question of the Steele case was, does the IRS have the authority to mandate that all tax return preparers have a PTIN? And if they do they have the authority to require a fee to be paid to get the PTIN? As all of us are aware, since about 2010, you have been required to have a PTIN in order to file individual income tax returns as a paid preparer. And at the same time, the IRS has charged a user fee for issuing that PTIN. Now, PTINs actually predate that date because PTINs were first issued back in the 90s as a way for preparers to not have to put their social security numbers on forms, but it was voluntary initially. And initially, there was no fee charged. When the IRS decided to mandate the use of PTINs on returns, the IRS effectively said, well, we're going to charge for that right. They believed they had the right to charge for it at that point. These regulations came out about the same time the IRS set up the Registered Tax Return Preparer Program. Steele challenged first where the IRS had the right to require PTINs on returns to begin with, and secondly, whether they had the right to challenge the fee. On the question of whether the IRS had the right to require PTINs, the court dealt with that pretty quickly. The court notes that Section 6109 of the code specifically grants the IRS, says you shall put your social security number on the form as a preparer, or any such other number as the secretary may require via regulations. The IRS has in Regulation 1.609-2D essentially provided for that you should instead have to provide a PTIN, which means you have to have one because you need one to put on the return. The court said, well, that's generally going to be considered valid unless the regulation is arbitrary, capricious, or goes against the law. They said, well, clearly doesn't go against the law because the law allows the IRS to do this very clearly. They said, number 2, it did not appear capricious. The IRS, in their explanation about why they wanted to do it, was it helped them police preparers, which is one of the things the IRS is charged with doing. One of the things that 6109 is meant to allow is for the service to be able to keep track of paid preparers, and they take responsibility. So the court had no problem with the IRS requiring you to have a PTIN. But the court had more trouble with the IRS requiring you to pay for that PTIN. The IRS relies on their authority for charging a fee on the Independent Offices Appropriation Act of 1952. Generally, in order to be justified under that, the Supreme Court has found, essentially, or I should say the actual law says, it has to be a service or thing of value provided by the agency. Now, the IRS said, well, it is something of value. You get to prepare returns by doing this, that this is what we get for that. The court was not so sure. The court said, look, this came out the same time, and the fee began the same time you started the Registered Tax Return Preparer Program. However, in the Loving case, we ruled that that requirement for people to be RRTPs was not valid. With that no longer valid, they said, previously, if that had been a valid program, then this would have provided something of value to the preparer, because they would have been, to be an RRTP, that would have been one of the things of value, is that whole licensure program. But they said today, when all you need to do, anybody in the country can get a PTIN, the court found that that did not provide anything of value to the person paying for it. As such, a fee was not authorized under this statute. Interestingly enough, this very issue, this pair of issues, had previously been addressed a number of years ago by courts in Georgia and by the 11th Circuit. In the Brennan case, the 11th Circuit had specifically upheld the right of the IRS to establish, to require a PTIN and to charge a fee for it. Now, the district court notes that case and says, but that was decided before Loving, so the RRTP program was still in place. However, after the Loving case, another district court in Georgia decided the Buckley case, and in Buckley, the court said Loving doesn't apply, the PTIN fee is still valid. So what's interesting at the moment is we have a little bit of a, let's say, tension between the courts. The district court in DC is saying it's not valid. We have an 11th Circuit case saying it is, and of course, the rest of the country is not saying much of anything at this point. However, due to the uncertainty at this point, the IRS has temporarily, according to them, suspended the PTIN site. At this point, you cannot apply for, nor can you renew a PTIN. Now, renewal is no big deal because that generally is going to be December 31st is your date. So I doubt there was actually anybody cared about renewing at this point unless they'd let one lapse. But the real problem at this point is you can't get a new one. Now, the IRS says they're doing this while they consult with justice about how to go forward. However, one big problem we've got is we don't know when this thing's going to reopen. So if somebody needs to get a PTIN right now, could be a problem. Next up, we're going to take a look at the Seaview trading case. This is Seaview LLC et al. Versus Commissioner, 9th Circuit case decided on the 7th. This is case number 15-71330. This is a case dealing with the TEFRA partnership rules. Remember, under the TEFRA partnership rules, we do examinations of partnerships at the partnership level. We get our income, deductions, and credits all decided at that level. However, if you're an eligible small partnership, then you are exempted from TEFRA unless you file to come under the program. An exempt small partnership is one that has 10 or fewer partners, and each of the partners must be an individual other than a non-resident alien, a C corporation, or an estate of a deceased partner. In this case, there were 2 partners. Each of the partners formed a single-member LLC treated as a disregarded entity, and that LLC held their partnership interest. The partnership came under exam. Now, various reasons, which we won't get into, the partnership had, it challenged the amount under the TEFRA proceeding, and so the IRS issued an FPAA. But now when they went to collect the tax from one of the partners said, wait. You weren't authorized to do a TEFRA exam in this because we never elected in, and we should be a qualified small partnership because it's a disregarded entity. So I should be treated as I held this individually. That means we had two individual partners, and that means we should be exempt from TEFRA. Now, the IRS a number of years ago in Revenue Ruling 2004-88 had said that if you hold it in a disregarded entity, which includes a grantor trust or a single member LLC disregarded entity, that disqualifies you because they're saying we don't care what we treat it for tax purposes generally. For TEFRA, if you hold it in a flow-through entity, this is under the code, the flow-through entity rules, a pass-through partner, I should say, is a 6231A9. Those are not eligible. And the IRS said, per their revenue ruling, that we hold that this is a pass-through partner. The Ninth Circuit upheld that ruling. The Ninth Circuit said specifically that we consider that the question is, was it held other than as an individual? The answer is yes. And because of that, you can't qualify for TEFRA. Now, we all know TEFRA is going away because we're going to have brand new partnership audit regimes effective for years beginning January 1st, 2018 and later. But what's interesting at this point is that the Joint Committee on Taxation suggested this same sort of rule could apply for partnerships that the IRS might decide to allow to opt out. Presumably, we're going to find that this case suggests that it may be likely the courts will go along with that view as well. Finally, this week, let's talk about the United States versus Ragic. This is a case from the U.S. District Court for the District of New Jersey, case number 2:17-CV01187, issued on June the 1st. This is a case of a taxpayer who had a client under exam. They got a summons from the IRS to answer questions and produce information. The preparer is suggesting they don't have to provide that information, that information can't be obtained by the service. And this particular person asserted both the tax preparer privilege and the Fifth Amendment right for self-incrimination. The court first looked at the tax preparer privilege. This is something that there's a lot, I should say tax professional privilege, get this right, federally authorized tax basically, in this case, practitioner, FATP. FATP gives you protection as a practitioner, federally authorized tax practitioner, CPA, EA attorney, but you only get the same protection. Obviously, attorney already has this, so let's talk about CPA, EA at this point. Only gets the same protection that would have existed if an attorney had been involved in the structure. What's clear from case law for years is return preparation itself is not protected by privilege. It's never been protected by a current attorney-client privilege generally, and so it's not protected for CPAs or EAs, even if we don't worry about the other issues here. Because remember, the privilege also doesn't work for CPAs and EAs if it's a criminal matter or any non-tax matter. But it doesn't matter. Even a tax matter, preparation doesn't. Why? Because a return is prepared for disclosure, and disclosure is what's always fatal to privilege. In this case, the preparer couldn't show that she had ever been engaged to do anything but prepare a return. She couldn't show where she'd been retained to provide advice. Because of that, the court said, sorry, you've not established that there's any privilege at all. The service has a right to ask these questions. Certainly you have to at least begin to answer the questions the service is asking. There's no blanket protection. But you said, but I'm going to claim the Fifth Amendment against self-incrimination. Well, the court noted that first thing is the Fifth Amendment does not protect you from basically throwing your client under the bus. If what you tell would incriminate your client, that's not subject to Fifth Amendment protection. Number two, while you can invoke it if you have legitimate concerns that you yourself could be criminally charged, she failed to show she had such legitimate concerns. The IRS pointed out that they were already past a statute of limitations to be able to indict her for any sort of criminal activity that may be related to the years they were looking at for that particular client. There was no current investigation going on her because she could not show a reasonable belief that she was at risk for criminal prosecution. The court also held that the Fifth Amendment privilege couldn't blanket prevent her from being questioned by the IRS. Now, the court did say, they're not saying that things might not come up once the questioning starts that would trigger this, but then she needs to assert it on specific questions, not just the idea of being questioned at all. And she still has to meet these burdens in order to avoid answering any particular question, has to show that there was advice thought she's going to go for the federally authorized tax practitioner privilege, or she's got to show a reasonable expectation of criminal prosecution for information she would relate for a question for herself, not for the client, in order to invoke the Fifth Amendment. The thing to remember about this is the privileges available to CPAs and EAs are very, very, very limited. So be very careful about any situation where a client's going to tell you something that we might not want to have open for discovery. This could be, this makes for some major problems because CPAs and EAs have a tough time working this. And if you are going to try to do the privilege, make sure that you very carefully wall off the stuff that might be subject to privilege so that we don't intermix it with non-privileged information, because that's, again, remember, disclosure is our problem. We have to separate the preparation function from the advice function. And frankly, most CPAs and EAs aren't trained on how to do that. So I've always said, if it really seems like this is a big deal, that where privilege will be important, you really got to get an attorney involved who, at the very least, can make sure nobody runs into trouble with the privilege problem because they just don't understand how to protect it. So be very careful there. It is the summertime. Your education time is here. Make sure you decide to get out there and begin to pick up things in order to be leaders in our profession, in order to lead our clients forward through the tax maze. You got to learn what's happening. And the most effective way to do that learning is to go ahead and get a live course where you interact with other CPAs in your areas, and that's going to be at your state society live CPA courses or CPE courses. All of the state societies have their offerings up now, so be sure to check for yours. Be sure to find something, and we'd love to see you at one of the courses coming up here. For those of us here at Loscalzo Institute, or even if you want to go see somebody else, well, then we'll accept that too. But go ahead and check your state society's offerings. This has been the current federal tax developments for the week of June 12, 2017. You can catch our updates during the week at currentfederaltaxdevelopments.com. You can also download a PDF with all of today's topics on that website under the current developments, the weekly audio and video updates page. If you have any questions or comments, you can send them to me, Ed Zollers at currentfederaltaxdevelopments.com. You can also follow me on Twitter. My address there is @EdZollers. Another week is coming up. Summer continues. We'll take a look and we'll let you know what develops in the coming week in the area of federal taxes.